Hey guys, today we're going to look at Microsoft stock. And Microsoft is a software company providing things like the Windows operating system, business tools like Word, Excel, OneDrive, so cloud computing, and also the Edge browser with, for example, and it also invests in ChatGPT and AI technology, which is also a good thing. So first, let's look at the graph of Microsoft. As you can see, it's almost at the all-time high, which means you won't get a big discount on it. I have also bought some shares in Microsoft, even though not as much as I would like, but a good amount, at 240 to 250, I think, around that area. So close to the uh, pretty close to the low right here. Um, so let's start by looking at the numbers first. As you can see, revenue is rising, even though its growth it's not rising that much year to year, and it's rising also quarterly. But you have to keep in mind that Microsoft is a really big company with 2.5 trillion in market cap, so I think it's the third largest company in the world, which is which is which you need to take in account, and it will probably not grow that much anymore. It also has positive net income, and its net income is also growing. Number of shares outstanding is decreasing, even though they bought back shares at high PEs, which isn't really a good thing, but at least it's not going up. So that's better than going up. They also pay a dividend of 0.8% around that. It's a good dividend to pay, but yeah. Their price to earnings is at 33 right now, which is a bit high for, I think. I would like it at 20 price to earnings. I would prefer it at 20 price to earnings, but okay. And their return on invested capital is around 30%, which could be due to them buying back shares, but it's a good return on invested capital. Which means they make around that amount of money on their money reinvested in the company. We also need to look at the cash flow. The cash flow from operating activities has grown to 87 billion, and their free cash flow has grown to 59 billion. Also, they have their net debt is negative, which means they have more cash than debt, which is a good thing, and their total debt is 80 billion, and compared to their income of 72 billion, they would need a bit more than a year to pay back their total debt, which means they don't really have the risk of not having enough money to pay their debt. So now let's look at the numbers. So first we'll put in the revenue, which is 211 billion. Then we'll put in a revenue growth of, let's go with a low assumption of 3% per year. Even lower than that, 2% per year. Yeah, I think 2% is the lowest I would go with. Then profit margin of, in the lowest case, 15%, which is really low for Microsoft. It normally has like 30 to 40% profit margin, and the price to earnings of 15 in the lowest case. Or even 10, let's do 10, but this is really the lowest and most unrealistic scenario. And we get a price of $14 to $15 per share. But these are as low assumptions. I don't really think these assumptions are realistic. So let's put in first a higher PE of 15 at least. That makes our price go up to 22. Now let's put in a more reasonable net margin of 30%, which would make the price go up to $44. And in this case, I would go with higher revenue growth of 3%. That would let our revenue go up to almost 300 billion. In this case, a good buying price would be $48. If we put in higher assumptions like 5%, where would that take us? Maybe 6%. So 5% would be a high number, 20 price to earnings, would give us a buying price of $78. In all these cases, by the way, we would still lose money at the end of the day. That's mainly caused by the high PE and the low growth, of course. We could also put in a higher profit margin right now. Let's put in the highest of 36% because due to their cloud business and more software focused business, they will probably increase their profit margin. But in this case, we would have a buying price of $94. Yeah, it won't probably be a 15% investment, as you can see. But let's try to make it. Let's see what how high our numbers have to be to get to 15% per year. 6% growth would almost double their revenue, which is a bit unlikely for such high revenue companies. And as we can see, we still don't get a better price, which is a bit annoying right now. But okay, let's put our numbers higher. 8%, 12%. Yeah, okay, it's getting really unrealistic. So if you want to achieve 15% per year, at least with this calculation and with a low PE, Microsoft is probably not the stock for you. Only if you think it will three times its revenue to 600 billion. But I don't think that's really likely. But let's put in a 25p, which is also a bit unlikely. And let's go higher with 15% revenue growth. We are almost there. 16% would still not enough. 17%. So with 17% revenue growth per year, you would make the revenue would go up from 230 billion to 1 trillion in revenue, and you would have a buying price of $350. So if you want to make 15% per year, Microsoft isn't a good investment. I would wait for it to go down a bit. I still like it as a company and I won't sell it. But I've bought it at 250 or lower than that. And to be honest, I don't really expect to make 15% per year with Microsoft. It's more of a safe investment to get some dividends. Maybe they buy back some shares and decrease the price, but not at these high prices right now. So if you think these assumptions are true, then this may be a good investment for you. But yeah, keep in mind these are really high assumptions. 1 trillion in revenue is a really high number. If the company only has, it's almost one of the biggest companies right now. But now let's take our other model. So let's try with our other model. In this case, we will take the growth rate from Yahoo Finance, 14% per year of free cash flow growth. And here we take 7% per year, terminal value 15. Here zero free cash flow is 49 billion. 49 in this case. Stock-based compensation is, let's put in 49,000. Stock-based compensation is 9 billion. So it's a fifth, a good amount. Not that much of the free cash flow is stock-based compensation. That's a good thing because you will get more money as a shareholder, as an investor. Net cash, net debt is 31 billion. And shares outstanding 7.4 billion. And in this case, the stock would be overvalued by 155%. our free cash flow would grow from 57 billion to 135 billion, less stock-based compensation. Which, okay, yeah, okay, I understand. Yeah, in that case, it's still not a good investment. We could, of course, always go with higher numbers, but 135 billion is also a big number, so keep that in mind for free cash flow only, less stock-based compensation. So also in this case, it wouldn't be a good investment. You would want to buy at $130 around that area. But you have to think which numbers you prefer and think are realistic, and think about if you want to buy Microsoft and at which price it could be interesting for you. If you liked the video, give it a like, and bye.